welcome to Power Charting. I'm Bruce Frazier, and with us today we have a very special guest, Joe Turner. And Joe is going to have a wonderful discussion with us about some things that we need to know. And so stay tuned. This was recorded on February 14th of 2019 for broadcast on February 15th of 2019 and thereafter. So first thing is, do want you to know that there's going to be a free webinar on February 19th where Joe Turner and his business partner, Martin Pring, are going to have an in-depth discussion about intermarket analysis, their decision-making process, the research that they use to manage portfolios, and it's going to be a wonderful presentation. We're all really looking forward to it. You go to tsaasf.org, you will see on the homepage at the top, you will see the announcement of their presentation, and right below you can click on register here and register for this free webinar. And also check out TSAASF, a wonderful organization. Become a member, and there's going to be a lot of really exciting things happening in 2019 and thereafter. Okay, so this is Joe Turner's disclosure so that you can see that. And here we go. Joe Turner is a portfolio manager. He has been in the business for 50 years. This is his 50th anniversary. And he is a remarkable market thinker. He's does incredible research. We're excited to have him here today because we're going to have Joe as a regular. We're going to have him come back from time to time and talk about how he processes information in the market, how he thinks about current situations, how he would manage portfolios. He's somebody who's been doing this real time with clients for 50 years. He broke off and started his own firm just about 40 years ago and has a tremendous amount of knowledge and wisdom for us. And he also has done a remarkable job as a portfolio manager that whole period of time. And so we may get into that a little more today. So without further ado, Joe, thanks for coming.
All right, Bruce, thank you for the invitation. And I always look forward to sharing experiences and a little bit of wisdom that comes out of all those experiences. You mentioned 50 years of looking and analyzing markets. I roughly calculate that's a little over 11,000 trading days of watching market behavior. And I have probably seen 11,000 different ways to lose money. And to pinpoint this a little bit more closer and why you understand where I started and also what formed the early years of my beliefs and my experiences. I did get licensed as a stockbroker in mid-December 1968. The Dow Jones, the week before I got out of a 6-month training program, hit its all-time high of just over 1,000 on the Dow Jones. And we did not see that level again surpassed for any period of time until 1982. So you can see the first 14 years of my experience, my first experiences, were truly exploring the many ways and wonderful opportunities to lose money because that was the secular long-term environment. So that's where, in order to survive and understand how to make money, making money is all about not losing money. And a corollary to that can be that Wall Street is designed to separate you from your money. So you put those two together, and making money is all about risk management, to use the proper term, to not losing. So that's what it is. And there's only one rule that you really need to know. That one rule is very simple. All you have to know is don't lose. Now, everybody is going to lose in the market. You can't make hundreds or thousands of decisions, investment decisions, about an unknown future and expect every trade to turn out. So the key is you will lose, but the key is don't lose big. And I'll certainly explain to you the whys and the wherefores of that, because I'm amazed by a phenomena, and it really only exists in the stock market. And if you look around you at life, if you look around at nature, there's the concepts of yin and yang, or in the stock market, regression to the mean. Think of a pendulum, how time works, but a pendulum goes from one extreme, slows down, it hits that extreme, and then it slowly comes back and swings to the other direction and hits an extreme and keeps coming back. That is more prevalent in life, that picture. But in the stock market, there's this cruel mathematics of losses. And that's the why you have to pay attention to not losing big. The cruel mathematics of losses. So let's see what we mean by that.
Well, before we move on, Joe, let me just ask you. So you've had 11,000 market days, and you've found 11,000 or more ways to lose. Does we ever get to a point, if we keep writing down every rule about how not to lose, or every way we've lost, do we get to the end of the list, or does this just do we keep finding new ways? Does this never end?
Bruce, 50 years later, and I still see ways, new things. Well, because market conditions change, technology changes, indicators change. It was easy to follow certain indicators back in the 60s. You had things like odd lot short selling, which told you what the small or more emotional or uninformed investor was doing, and you tended to do the opposite of that. Well, we have many more tools today and vehicles and technology that shows us there are different indicators and there are different players. So the landscape, the investment landscape, is continually changing. And you bring up a good point. What you need to do is to have tools that can make decisions through an ever-changing landscape, through an ever-changing technology. So different ways.
You're causing me to think about experiences I've had in the past with technology, where the technology went wild on me, and maybe these are stories for a future episode. But anyway, so
sure. Well, you well remember October of 1987, when we didn't have to worry about big market declines because we had, quote, portfolio insurance, end quote. And of course, that turned out to be a self-reinforcing market massacre, 22% in one day.
Yeah, it was like a circular firing squad.
Exactly.
Yeah, so, I was right there with you when that happened, and we were sort of in awe. That was quite a moment.
It was something to behold. A whole bull market transformed before our eyes in a couple of hours.
Oh my gosh. Okay. All right. So should we move to the next slide?
Sure. Go ahead. So this is what there are, just new ways every day to lose money in the market. So, but this is the phenomena, and this is what I was referring to as the cruel mathematics of losing, because it's not just a symmetrical exercise where if you lose 10%, you just have to go up 10% to get even. No, if you lose 10%, you have to go up 11%. If you lose 20%, you're $100 drops to $80. To get that $20 back to break even, you're working on an $80 base. You've got to go up 25% to break even from a 20% loss. And of course, it gets worse. If you lose 50%, then you need 100% profit, to get back to that break even. Now,
Well, this doesn't seem fair to me, Joe.
it's not fair. That's why I say it's cruel mathematics. It's something that we have to experience and live with, and why it is so important to avoid those deep losses on the left side. You're going to have losses in the portfolio. The stock market's going to have movements. I think on the 10% decline variety, we probably have close to 100 of those, in the last 90 years or so. We've had more than, since 1928, I think, we've had 25% declines that have dropped more than 20%. So take our, just the recent experience, March of 2000 to October 2002, that was 31 months decline, and we dropped 49%. So that's one of those deep varieties. And of course, we went even further in 2007, 2009, the market dropped 17 months, dropped 57%, almost over there where the 60% decline is, and you need 150% advance to break even. So those are things that we are realistically faced with, and that doesn't even count, from an investor standpoint, the recovery time. So history, so not only are you losing money going through the left side here, but now how much time is it going to take you to recover and get back to the break even? How much time have we wasted by holding on to having those large losses? So
like 1987, the market declined substantially in about 3 hours, and then it took a long time to recover those losses and get back to prior high prices. So this is implying, of course, the notion of buy and hold also. So,
exactly.
Yeah.
Well, we'll show you in a minute that concept of buy and hold. So just keep in mind that history shows us over the last 90 years that the market has declined in 42 of those 90 years, or the market goes up 48 years. But you just have to calculate and put into your process that losses are normal, losses are cyclical. You just need to avoid the big losses.
Keep them
simple.
Yeah.
Right. So let's look at more recent history, and let's just look at the real world in the last 20 years. So you have a chart here of the S&P 500, 20-year history, and the green marks when you're making money, and the S&P is going to new highs. And then if we have significant drawdowns, maybe the 15% variety or something like that. So you can see everything was pretty good, 1998, 1999, up until 2000. And then, of course, the market started a periodic bear market. Now, it also took time to recover. So what we're showing here is, when did we get back to making money? When did we get back to increasing our net worth and our portfolio value? And you see, we finally started making money in the middle of 2007, and of course, only to be hit with what? The great financial crises. The market, the S&P dropped 57% in a year and a half. Now, here's that principle again. It takes time to recover those losses. When do we get to making money in our portfolios? If you're just using the S&P or just a buy and hold investor in the S&P, you're out here in 2013. So finally, we're making new highs in our portfolio. Let me just use an example. One of the beliefs is, or common experience, common knowledge sold by Wall Street is, well, the stock market goes up 8 to 9% a year. And when you retire, you could safely take out, say, 5%. Your portfolio would still grow, and you'd, on $1 million portfolio, if you could live on 50,000, drawing from your portfolio, would be in great shape. But this shows like sequence of risk. On our website, we have the example of a person that retires with $1 million in 2000, safely assumes they could safely take out 5% a year and reinvest. And I voucher nobody could guess what that portfolio is worth today. And make your guess. But the reality is that portfolio, taking out $50,000 a year, is not way up at the peak. That investor has about $320,000 left in their portfolio. That chart's on our website, but you can play the math yourself. It's just the lesson is you need to develop methods or techniques or a process system, a methodology to avoid those big drawdowns. And let me just leave us on that note. It's enough about losses, but you can see why if you just do that one rule, just avoid the big loss, you'll experience the miracle of compounding your wealth. So let's.
One of the things that I'd like to point out here about Joe is, of course, I've known Joe, worked with Joe. He's my mentor. Everything I know about financial markets, I learned from Joe and Hank Pruden. We were kind of a threesome. And then as time went on, Martin Pring became a very important mentor to me also. And Martin Pring and Joe Turner are partners, as we know. But the thing that I really appreciate about Joe and Martin is that they are what I've always called three-dimensional risk managers. And so Joe, as you can tell, Joe's obsession is risk management. And so he spent an inordinate amount of time thinking about all of the different ways, techniques, methodologies that he could use to be able to put a protection under the portfolio. And so because of that, there were all of these different substructures, I would call them, in the portfolio to protect it in the event of an uncertain decline, like an 87 or like here. You can see this is from 2000 all the way to 2012. There's no net progress in this market. All it's done is create huge amounts of volatility and no net appreciation. And this is a remarkably long, frustrating period of time to have no progress. And so there needs to be tools and techniques to be able to take the dips out of these, out of portfolios that are being created by these markets. And so this is one of the things I hope we can do more with Joe as time goes on. Okay, here we go. Sorry, I had to jump in there and say that.
Yeah, that's great. So the bottom line is you have to have a process or a methodology to be able to handle losses. One of the, I think, greatest advances in my efficacy as a money manager starts out with ourselves, with me or with you. And I love the country western song by Toby Keith. It's all about me, me, me. And it truly, that's the place to start if you want to be successful in the market is really understanding how you are wired, and humans, not only is Wall Street designed to separate us from our money, so is our wiring, the way that we, our behavior. And some of these are the antithesis of making money in the market. But for me, the greatest advances were when, and Bruce and I did this journey together in the early 80s or mid 80s, is just understanding ourselves better. Bruce mentioned Hank Pruden, professor at Golden Gate University, a delightful character who loved analyzing markets. But we spent many years with a group studying ourselves and our behavior. Came up with something, and Bruce, this is maybe a program for another time, but Hank and it was a result of a number of these meetings, worked with Van Tharp, who's a performance coach for traders and investors, came up with something called the 10 tasks of trading. And you could all Google that, but I think that's a great place to start. And the first thing is self-analysis. So, but let me move on, because I want to talk just a little bit here about an antidote for losing money. And I said everybody has to have a methodology or a system. And this is just what we have developed over those 50 years, is just a way to look at markets and be able to come up with a decision-making process where we, even if technology changes, markets change, and so on and so forth, that we can continue turning the crank and come up with a successful conclusion and positive investment results over almost any kind of environment. So for us, this starts out with looking at the big, broad picture. I mentioned at the beginning when I started talking that I parachuted into the industry in December of '68, and for 14 years watched the stock market go down. That's a secular period. So we want to know what the secular outlook is for the three main investment groups that we have, the stocks, bonds, and commodities. Early in my career, I was turned on to the Bank Credit Analysts and Money and Investment Profits, a book that was written by the founder of the Bank Credit Analysts. That's also where I first was introduced to Martin Pring, who was a technical analyst for the Bank Credit Analysts back in the early 70s. And that's all about business cycle analysis. Where we are in the business cycle really is the greatest influence on whatever asset class we're looking at. So that identifying where we are in the business cycle helps us with the asset allocation decision, what sectors we want to emphasize or not emphasize. We'll break it down further into what's the market outlook for the next, say, 2 to 6 months. So we've got the big picture, the secular, we've got the business cycle. Now, if we look at the stock market, every 2 or 3 or 4 months, there's a turn. Either the market turns up or the market turns down. And so there's opportunity in that intermediate time frame to plant or prune or whatever. And we use a model we call the fuel tank to do that. The last decisions we make about investing are we want to put high quality, good value, and high solid income into a portfolio. And from quality standpoint, Standard & Poor's has done research work that will show the advantage of staying with high quality. There's all sorts of value studies out there. And of course, income, we like to create more income than the market provides us by our stock selection process. That gets us eventually to our investment portfolio. So it's a combination of these things. This is our system. This is our decision-making process. And I just ask you, what is your system? What is the process that you make decisions and that you can keep doing over and over and over again? And you learn from each exercise. You learn how to improve or tweak what that system is. So,
and buried in this pyramid, this inverted pyramid, are these many dimensions of risk management. And it's a little obscure right here because they have to be sort of unfolded and talked about. And these are the things that I'm hoping that we can do with Joe in future episodes, is that we can literally drill in. Because the thing that Joe and Martin do really, really well, better than most everybody, is that they're exceptional model builders for different environments. They are really good at the long term. They're good at the business cycle level and at the intermediate term in terms of doing their building decision-making processes out of technical indicators and then turning those into portfolio management decision-making processes. And we want to, in the future, is to have some of this revealed to us. Martin does a lot of this in his blog work and in his presentations at stockcharts.com. And we would like to have Joe reveal some of this to us, because Joe, in his own right, is exceptionally good at this also.
Let me, I have probably time for one more little section here, but just to circle back what Bruce said about Martin, I think his upcoming talk will talk about the business cycle and maybe some of the intermarket relationships that he sees in this current business cycle environment where we are today. So I think that he'll shed more light on that.
I really want, this is a personal thing for me, because I've seen Joe work with this tool for the last 40 years, and is the fuel tank. He's called it other things in the past, but the essence of it is the same. And so the fuel tank, and Joe, if you could just give us just a really brief, in the last couple minutes we have, overview here.
Sure. So recall that we have in our inverted pyramid or decision-making process, we get down to looking at what's the outlook for, the next 2, 3, 4 months, because we'll get several of those opportunities a year. And what we did is we designed a fuel tank to try and identify the low risk or high risk windows for the stock market over the next few months. And there's, you could imagine on an intermediate basis, there's more sentiment involved and direction of interest rates or liquidity or whatever that comes into the decision. So looking at the scale on the right, we have 0 to 100. It's plotted inversely to the New York Composite, the blue graph. And it just shows that when the fuel tank fills up and we get these 80 or 85 or 90 or 95% readings, we tend to have a full tank of gas, and the market can proceed upward and travel a distance, a profitable distance. So we highlighted this indicator back in early January at the technical security analyst talk, and it was about 96%. We said, hey, it's a low risk window. The fuel tank is full. The market can travel north at a pretty good speed. So that's where we are, and now we're starting to wear off some of the good stuff off of that, because the fuel tank is now only 70% full.
Okay,
so it just
Joe, sorry, go ahead, conclude your
no, it's just going to say it's just a good little tool that helps us identify, again, the 2 or 3 times a year that we might get a decent opportunity, because things are lined up, the fuel tank is full, the market can go.
We're going to get Joe to tell us about how he decides which components should go into these indicators for the time frame that we're in. We are just about out of time, but Joe would like you to know that you can go to pringturner.com to their blog page, and you can sign up for their newsletter, which is a must read. And then also do come back to listen to Martin and Joe talk more about this very subject on February 19th. And thank you for attending today, and we'll see you next time.